So, 100%. We called it. Bed Bath & Beyond. Bankrupt. They have filed for bankruptcy protection. They have begun liquidation. This should really not come as a surprise to anybody, though, to be perfectly honest. This is breaking news, of course. But if you looked at their financials, not really all that breaking. Let's see what the geniuses at CNN and CNBC have to say about it. Bed Bath & Beyond, the store for seeming everything in your home from the 1990s to 2000s, filed for bankruptcy on Sunday. Thank you to all of our loyal customers. We have made the difficult decision to begin winding down our operations. Yep. It's as though the fact that they don't make money actually eventually mattered. It was a crown jewel of the era of category killers, chains that dominated a category of retail, such as Toys R Us, and look how that turned out for them, Circuit City, and Sports Authority. I don't really remember Sports Authority. Those companies ultimately filed for bankruptcy. They turned away from specialty stores in favor of online options like Amazon. I mean, is it really all Amazon's fault, I wonder? Let's see here. So, just to point it out, the most recent quarterly financials really could have told you that there was some problems, right? And this is why, even though it's not exciting, we look at the balance sheet, okay? Assets declining, cash declining, shareholders' equity becoming a deficit, going from a $174 million equity to an almost $800 million deficit. Yeah, that might not be a good thing, right? Net losses of almost $400 million. in one quarter. And this is not a giant company, right? This is a $138 million market cap. So this isn't like if like a really, really big company like, Apple or something had something go really hairy one quarter and they had a $392 million loss, compared to the size of the company, that wouldn't be that big of a deal. But for a company, they're taking losses that are more than their market cap in a quarter. That's just insanity. The fact that anybody would think that this is a stock that you should be buying, they would literally be better off just going to the gas station and buying scratch offs. That would be most likely a better decision for those individuals. So I just don't get why people would buy this kind of business hoping for some kind of a squeeze. I mean, okay, yes. There's a lot of short interest. No doubt, right? But the company literally has been just rocketing towards bankruptcy, okay? Like, absolutely just runaway locomotive heading towards bankruptcy. So, of course, people are going to short a company that's about to go bankrupt. That makes sense. But then you have a company like MPW. Okay? This also has a lot of short interest. Okay? And unlike Bed Bath & Beyond... Hey, Jonathan. So, unlike Bed Bath & Beyond, this company not only, has its hefty dividend, but if we do go into their financials, what you're going to find is that it's not even remotely similar. Okay, so again, Bed Bath & Beyond, just for comparison's sake. Okay. Shareholder equity rapidly turning into a deficit. MPW, shareholder equity not growing much, but still growing, right? So you have a company that's financially gaining ground while paying a great dividend, and whose net assets are significantly higher than its market cap, and has a huge amount of short interest, compared to this company, which is very apparently on its way to bankruptcy, a deficit of $800 million with a market cap of 138 million and seemingly no path towards any kind of profitability other than some kind of a miracle, diluting shareholders just to stay alive, and with nothing really worth anything other than some crappy, outdated inventory and a bunch of leases that they'll probably have to buy their way out of. So I don't get why people would want to buy this, praying for a squeeze when that's literally the only way that they'll ever see any kind of return. And this gets ignored when you've got tremendous amounts of assets just sitting here. You've got FFO covering a beefy dividend and a clear price value disconnect, right? Yeah, there are some tenant issues, some interest rate issues, possible risk there if they have to refinance their debt at higher interest levels, but they're doing a hell of a lot better than Bed Bath & Beyond. Yet, what is it that people keep trying to, make a squeeze happen on? Bed Bath & Beyond. And I don't get it. If it's just, maybe it's just the fact that the share price is so much cheaper that they feel like they're getting a better deal or something like that, but no. Are you saying you've got 35,000 shares of Bed Bath & Beyond at 89 cents? Because I've got to tell you, it was a bad idea from the beginning, man. Like, seriously, look at these financials. Like, this is all you had to do was look at these financials and see that they went from equity of about 174 million down to a deficit of 800 million. That is circling the drain. Their market cap is only 138 million dollars. So they're in the hole in terms of assets and liabilities more than their own market cap. It's a bloodbath, man. And that's why you have to look at financials before you start buying something. Even if you think you're buying it for a short squeeze, if that's the only way that you see a profit, then it's bad, right? Because, as I was pointing out, MPW has actually more short interest as of the last time Fintel's numbers got updated. So more people are shorting MPW, but their financials are pretty much the exact opposite of Bed Bath & Beyond. You've got equity of $8.5 billion. That means compared with their liabilities, their assets outweigh their liabilities by almost $8.6 billion. Their market cap is under $5 billion. That means they have more net asset value, a book value, higher than their own market cap. Meaning if they were to go, to liquidate everything like Bed Bath & Beyond is doing right now, on paper, the average shareholder would expect to see a return, right? So, and some people say that, I'm being Ben Graham about this and that MPW is a cigar butt with just one puff left in it and all that. I look back historically, REITs got beaten up a lot, 08, 09 because of the real estate collapse and everything. These guys were at like $3 a share. Now, if you had been buying during that collapse and gotten gotten a hold of it at those kind of lows or in that area, right? Let's say you maybe got in at an average of 5 and because you didn't catch the exact bottom or something, right? You still would have done so well that you would be actually, if you include dividends, up so much today, right? And that's why I try to go after things when they're mispriced, but based on their financials, not just for the squeeze. The squeeze would be kind of like a cherry on top, right? I've got 1,000 shares of MPW. If something did happen with, all that short interest and you did get a squeeze of some kind, fantastic, right? Because, I would see a tremendous, windfall on my shares. But even if that doesn't happen and they just slowly recover over time back to near their intrinsic value, I'll still make a pretty respectable return, especially when you factor in dividends and everything, right? So there's got to be more to it than just, I think this is a squeeze. Otherwise, if you buy everything that just has a lot of short interest hoping for a squeeze, overall, you're going to lose, right? Because generally speaking, when companies are heavily shorted, there is at least some perception of an issue. And sometimes that issue plays out and the company goes bankrupt, like Bed Bath & Beyond. Everybody, thinks that every company that they see with short interest is going to be the next, GameStop or the next AMC. But that just really isn't the case, okay? The mother of all squeezes and events like those, they're not the norm, really. Usually, when a company is heavily shorted, there's at least some kind of reasoning behind it that makes sense. And that's why you have to look at the financials. So, Jonathan, do you view do you actually do you ever look at the short interest just out of curiosity when you buy a stock that's down? Because I first got into MPW. I got my first 100 shares last fall. They were around $10 a share or something like that, and that actually ended up being my average. But I wasn't looking at the short interest initially. It was as my position increased in size, I started looking at the short interest just because I was curious why it was taking such a beating, and then the short interest made it kind of make sense for me. And then, of course, I thought of, GameStop, AMC, and all that other stuff, and I thought, hey, wouldn't it be interesting if, this stock had something like that happen on it just, randomly? Yeah, definitely. So my idea is if this did, if it did have some kind of a really big squeeze situation, if it went way above its intrinsic, I might trim my position somewhat just to realize some profits, because honestly, I don't think this is worth more than maybe 15 or 16 bucks a share, right? I think that's probably about what the financials support. So if it went really far above that, obviously with 1,000 shares, I'd say, hey, this was just a situation where I happened to get lucky on something that was undervalued and, take some profits at that point. But I'm not really looking for that to happen. I am looking for maybe, a reasonable low double digit return over, a very long period of time. Speaking of the Bed Bath and Beyond thing, though, I wanted to look at what the geniuses over at CNBC were saying about it. Oh, they're referring to them as beleaguered. Yeah, that's definitely true. Isn't that Nvidia, Jonathan? When you say you got that for undervalue, what does that mean? Because I don't think I've ever seen a point in the recent past where Nvidia was undervalued. $4.4 billion in assets and $5.2 billion in debts. Yeah, that's not a position you want to be in. So what's your basis on Nvidia, like cost basis? Yeah, see, they've just been trying to fend off bankruptcy by issuing shares and diluting, and it's yet, man, I feel bad that people threw $360 million into this. Probably a lot of them just hoping for that short squeeze that wasn't going to happen. Scratch off lottery tickets. That's all that was. $180 fair value on Nvidia. Okay. So what was that, like a 90 PE or something? Roughly. I don't see it, to be honest with you. Like you're up a lot, so you might feel right, but like, how do you justify that valuation, Jonathan? like, did you run discounted free cash flow or something? Because I'm gonna guess that. Okay, I'm gonna guess that it's not gonna be assets, right? So net asset. So obviously, you don't usually judge a company like this based on their book value, but 22 billion compared to a market cap of almost, you know, and again, you bought it lower, so it would have been what, 450 billion or something instead of 669 billion. But I mean, so it's not the balance sheet justifying it for sure. Or all right, so why don't they call it a statement of cash flows? See, I really wish that companies would all call their financial stuff the exact same thing. All right, income statement. So their revenue is $27 billion. You're paying. So you're. That's all. That's a. You're paying a lot, even at 180. Like if you want to, I just. And if you're saying it's the growth, I mean, like, at least year over year, it's kind of flat. So, like, how do you justify the multiple? I mean, yeah, 2021 to 2, big jump there, but aren't we expecting? Those were kind of some high highs for their products. Aren't we expecting things to come back down to earth a little bit, or stay more or less flat? So how do you, like, I don't understand how you justify 100x multiples on something unless it's got just fabulous growth, like it's going to double year over year or something like that. And just because I don't understand it doesn't necessarily mean that it's wrong. But, like, if I were to run a discounted free cash flow on that, I don't know. Okay, the demand is crazy, but, like, isn't the money what matters ultimately when you're buying an investment? I mean, they were saying the same thing about the demand for Tesla. It's always crazy until it isn't, right? The money, the money's the only thing that matters in the end, because that's how you see a return. Come on, Jonathan. Let's look back at the table of contents here and see if we can find their financial statements and their cash flow statement is what I want. Statements of cash flows. There we go. So, cash from operations, huh? Cash from operations down? It's crazy. Net income also down. So when you say the PE for Tesla and future value is so off, do you mean that Tesla is overpriced or underpriced? So let's see, if this is their capex and you subtracted off their cash from operations, just under $3 billion in free cash flow. So granted, they had $9 billion in free cash flow the previous year. Geez, they're all over the place, Nvidia is. But I mean, let me see if I can find a good discounted free cash flow model just to kind of illustrate. And okay. Okay, let me see. No, not that one. This one maybe. Okay. And granted, like, it's gonna be based on some different assumptions. So, for example, discount rate is 10%. Yeah. So like with the default assumptions in a discounted free cash flow calculator, Nvidia is worth about $60. 10-year analysis with a pretty big growth rate and hey, maybe you think that that's too aggressive or whatever, but what assumptions would you change in this calculation? Would you make the growth 25 for the next 10 years, 25% over the next 10 years? I mean, per year. Is that a reasonable annual growth rate? Lord, this is why I hate using free tools, though. The pop-ups and such. Absolutely crazy. But, what... And keep in mind, like, having that much growth every year for 10 years for a company that's already this size is a tremendous amount of growth. What point... And keep in mind, this is with a discount rate of 10%. Your discount rate in a discounted free cash flow model is your desired annual return. You can get 10% just by buying SPY. So if you're choosing an individual stock, I would argue you would want above a 10, but okay, well, I'm at a 35% growth rate and we're still only at 163 with a 10% discount rate. So, this is pretty much what... All right. And if you were to say, hey, I want to at least get 12% if I'm buying an individual stock, There she goes. But yeah, default on the thing was 20, right? And, even if you take it to 25, it's worth $84. So, and then this, again, it was with a 10% discount rate. Some people use lower discount rates, like 9%, 8%, but even still, right? Like, when I determine Nvidia's dividend is not okay, it's almost non-existent. I don't even consider it a dividend stock, though. It's great that you're up, but if I had bought Nvidia in the past for a lot less money and saw it at the price it is now, I would not be able to press that sell button fast enough, to be honest with you, because I would be like, I don't know why I cannot justify the current valuation. I basically, if I can't justify why I would want to add to my position at a certain valuation, I would probably be looking for the exit, just because the disconnect here seems so ridiculous to the upside compared to any reason. The numbers do not lie, right? Like, this is, with the assumptions we have in here, this is the value of the future stream of cash flow that this investment will give you. If you assume 25% annual growth over, each year for the next 10 years and that's average, with approximately 4% thereafter. You could increase the terminal growth rate, but it's like, who can really say? It's so much harder to predict what growth will be after the next 10 years, right? 315. What is that based on, though? If you take any DCF calculator and use any assumption that's anywhere near reasonable, I don't see how you get there. And yeah, I'm not telling you that it can't reach 315, right? But I would say that that's a completely irrational number. It just does not make sense to me, And granted, there are other DCF calculators that may work slightly differently from this one, but it's pretty much, every DCF calculator is basically just an Excel sheet that takes your inputs, calculates what the future stream of cash flow is, discounts it back to today's rate by your discount rate, and spits out a fair value based on the numbers that you put in, right? So, again, like, if you think any of the numbers, if you think the discount rate's too high, if you think the 25% growth for the next 10 years isn't enough, tell me and we can recalibrate. But, I think this is probably somewhere in the realm of right, more so than, yeah. I think I might have Nvidia watch listed at like $75 or something. But hey, for fun, you did say you think Tesla is overvalued. So, what do people think Tesla's going to grow by? Let's give them the 25% that we were giving to Nvidia. They're closer to the mark. 164 if you give them 25% a year for the next 10 years. You know, and but again, that's with a 10% discount rate. Personally, like if I'm going to buy an individual stock, I want it to be for a price where I can expect a return that's higher than the S&P 500. Otherwise, I might as well just be in SPY. I don't really care about Ford. Honestly, I don't like the car business all in all. Now, if they were cheap enough, sure, I would be interested in picking up something for really, really cheap. But yeah, I mean, their fair value is showing negative. So yeah, Ford is not doing too terribly well. If a company shows negative in their discounted free cash flow, it means that their free cash flow was negative. So yeah, I'm not interested in. I'm not. Well, okay. So yes, companies can temporarily have negative free cash flow if they have a lot of capex, like Intel. I think had, maybe it was just for one quarter or something, but I have a lot of Intel, by the way. Now, it's funny. So, yeah. If you say that their growth rate stays about the same and you apply a higher discount rate like I like to, yeah, I mean, it's possible I overpaid for Intel. But, and then that's if you apply the higher discount rate like I usually do. But I'll tell you what, this fair value comes in a lot closer to my basis than Nvidia did to yours, right? Now, if you go back to the 10% discount rate, and let's say I think growth is going to be a little bit higher. Well, maybe I'm really confident in their foundry business and their their new nodes and everything like that, right? Let's say I think that they're gonna really crush it over the next 10 years, right? And hey, this is an 11.5% growth rate, right? This isn't me assuming they're gonna grow by 50%, right? Well, suddenly, geez, they look pretty good. Even if I go with a 11% discount rate, and I just want to, beat the S&P by, a modest amount, right? It's basically we're within the realm of rationality, right? When it comes to Intel, you just have to be slightly more confident than the default assumption for that to start to make sense. But with something like Nvidia or Tesla, they have to just absolutely crush it consistently for 10 straight years with no blips. And based on that, I mean, they have to crush it beyond crushing it, right? And, and then, even then, you only get a market matching return. Like, I don't know. I just can't wrap my hand around the numbers for how Nvidia is worth $180, $260, $315, any of these prices people are coming up with for it. It just does not make any sense to me. But hey, you know, obviously, you paid 180 and you saw something, and now the price it's trading at is definitely way higher than what you paid for it. And if it does reach 315 and you exit, yes, you will have made a lot of money. And you may not have gotten there the same way I would get there, but that doesn't mean that you're wrong, right? But for me personally, like, and granted, right, this could be a blip, right? They could, like, companies can temporarily have like really outrageous PEs because of like a one-time write-down or something. But I've watched stocks over periods of time, and it seems to me like these really high valuations have just been kind of normal for Nvidia, normal for Tesla, normal for AMD. I mean, that's another one where I just don't get it, right? People say, oh, AMD is going to come out here and it's going to put Intel out of it. They've been saying that for 20 years, by the way. I mean, I used AMD stuff the first time I built my own gaming PC when I was like 15 years old or something. Okay, so people have been saying this for 20 years, and Intel is still here, right? And still makes more money. So, I mean, here you go. AMD, 105 PE, right? I mean, what the heck? Oh, Ryan. So here you go again. Like, if you just use a discounted free cash flow with like the default assumptions it has for AMD, it's got a fair value of about $10, right? That's hilarious. But okay, I mean, oh no, they're a growth company. So hey, let's give them 25% growth for the next 10 years. That's compound annual growth rate, and hey, it's worth $42 if you give them credit for that. That's pretty awesome. It's only $88, so you're only paying double the fair value at that point. But again, if you want to make a market beating return, you have to do a higher discount rate. And look how quickly, even with the higher growth rate, that the price goes down if you say you want to make 12% instead of 10%, right? Right. Yeah, basically, yeah, the margin of safety is how much you're paying below fair value if you buy it currently. So, yeah. And again, the fair value is just an output of what it calculates based on our assumptions of growth, right? So you can really do, like, you can't, now DCF is not appropriate for it's not appropriate for banks, REITs, and BDCs. Okay, so make sure that you use the appropriate valuation method. Like I sometimes do see people like just throwing any old company into a DCF calculator, and they'll use it on like a REIT or a bank or something, and it's like no, you can't do that. Yeah, you got to use now something I like, and something I would like to see maybe more places offer is a dividend discount model, but it's hard to find them for free online. So I also, I do have access to some paid tools and such, but I kind of like to show people how they can do essentially the same thing for free. And on this site, you can do it for free, and you just have to put up with the occasional pop-up, and you can get discounted free cash flow. So some people like to build their own Excel sheets and stuff. Now, I personally hate Excel, so you probably won't see me building any cool Excel files to share with anybody. But that is essentially what is going on in the background of this and any other website that does these calculations. It's basically just each of these is a cell on an Excel file, and based on any input you change, it changes the outputs. It's just a formula. No different from so this is Guru Focus. So for most standard businesses that make and sell a product or service that isn't like loans or real estate or whatever, I think discounted free cash flow works pretty well for most companies that most people would look at, right? So everything from Intel, AMD, NVIDIA, all the way up to stuff like Walgreens, Apple, Meta, Alphabet. But for other kinds of business, you wouldn't want to try to put Bank of America into this, or Realty Income, or Vici, or Maine, if that makes sense. Because a lot of those financial type companies, you really want to look more at the book value. Even with REITs, I think you want to consider the book value. Because ultimately, it's the assets are the thing that they make their money on. So you want to pay potentially a discount to the value of those assets if you're a value investor, right? And by the way, just because you're a value investor doesn't mean you're also not a growth investor. Just you want to pay a reasonable price for the growth. Because the price you pay ultimately is what determines your return, okay? So if you pay a lower price for a future stream of cash flow, that future stream of cash flow gives you a higher return. I think that's pretty intuitive, right? Here, I'll even give you the link to the site. There's two value investor based YouTube channels that have, I think, they have their own sites with a similar discounted free cash flow type model that you can pay for. One is Learn to Invest with the guy's name is Jimmy. He's the host. And then the other one is Everything Money. They both have a similar DCF tool. And the prices are different on each one, but they basically do the same thing. I've heard that Joseph Carlson has software as well. I don't know if he has a DCF calculator in his, but if he does, it probably does the same thing as this too. This is free, but you got to tolerate pop-ups. And you might be able to get something like that on, Yahoo Finance or Y Charts or something. I haven't looked too carefully at those. A lot of the times, all you really get on sites for upgrading to premium is like different Morningstar things, like buy and sell ratings and things like that, bull and bear cases. Honestly, analysts take anything they say with a grain of salt. Personally, for my part, I like to come in on my fair value calculation. I feel like I know I'm on the right track if I come in below analyst price targets. Okay. Anyone want to translate that for me? We've been going for almost an hour now. It really flies by when you're having fun. Jonathan, you have been a very, very fun person to talk to. Anyone have any final thoughts before we head off? Just remember, the financials matter, and buying something just on the hopes that there's going to be some kind of a short squeeze, not advisable. I think if you're going to gamble, you might as well go to the casino, because then at least the drinks are comped, and you know, at least scratch off lottery tickets, support and fund the schools in your state. But buying Bed Bath and Beyond stock, that doesn't benefit anybody, and as far as I know, they're not comping your drinks. So yeah, that's, I feel bad for the guy from earlier in here who was what is it? He said he had like 30,000 shares or something. 35,000 shares at 89 cents a share. I mean, geez. So, he had over 30 grand into Bed Bath and Beyond stock. Like, I really hope he's got a lot of money and can afford that. But, that's the thing that worries me when people hype up these, squeezes on these almost bankrupt companies. Like, a lot of the people that get into them and, go